Welcome to This Explainer. You know, it's pretty wild, but a massive percentage of so-called value-add deals completely miss their return targets. Today, we're moving way past the glossy marketing brochures and those exaggerated stories of real estate riches to uncover the grounded operational reality behind true value-add multifamily investing. If you've ever wondered how genuine, durable wealth is actually built in commercial real estate, well, you're absolutely in the right place. Let's dive right into this.
Let's just completely shatter a common illusion right off the bat. The idea that you can pull the classic landlord special, slapping a fresh coat of paint over the light switches, planting a few shrubs, and just crossing your fingers for market appreciation automatically creates a profitable value-add investment? It doesn't. True value-add is a strict discipline. It requires a crystal-clear, actionable plan and rigorous operational execution. It's all about fundamentally improving how a property functions day in and day out.
So to properly demystify this whole process, we're going to walk step by step through the Deko Capital deal lifecycle. We'll cover the value-add myth, finding the operational gap, the value creation plan, the execution differentiator, and finally, measuring durable value. Section 1, the value-add myth, moving beyond cosmetic flips. Okay, so before we go any further, we really need to redefine our terms so we understand what drives actual durable returns instead of just flashy short-term optics. Value-add investing isn't about finding a cheap building and just holding on to it. It is literally the process of finding properties where current operations are falling way below their market potential and then actively closing that gap through a deliberate, highly structured business plan. It's entirely about closing the delta between what an asset currently produces and what it absolutely should be producing with the right operational strategy. Section 2, finding the operational gap, discovering where the value hides. Look, before we even examine a single property to find its specific operational gap, the macro environment has to make sense. We're talking 3 foundational pillars. Are jobs actually coming to the area? Are people moving in? Or are they packing up and leaving? And, this is crucial, what does the supply pipeline look like over the next 24 months? Because honestly, a strong asset in a weak market, that's a massive headwind that no amount of genius management is going to fix. The market simply has to work first.
So let's say the market checks out. Great. Now we look for specific indicators of operational neglect. Imagine a property is just sitting there at, say, an 88% occupancy rate, while the surrounding market is averaging 95%. That 88% isn't an accident. And it's definitely not a demand issue if the guy across the street is full. It's a flashing neon sign that something is seriously wrong with the current operations.
So what's actually creating that 88%? Well, here are your prime indicators of a real operational gap. You've got occupancy falling below the market average, of course, rents sitting 12% below market potential, and yeah, sometimes a tired owner does that intentionally, but often it's just pure neglect. Then you see a huge backlog of deferred maintenance, meaning the property hasn't been properly reinvested in. And finally, abnormally high resident turnover rates. People are leaving because of slow maintenance, bad communication, you name it. That exact gap, that shows us exactly how much value we can create through strong execution. Section 3, the value creation plan, structuring the turnaround. Now, you obviously can't fix everything on day one, right? You need a highly disciplined, structured plan to actually close this gap. We follow a really deliberate timeline. Month 1, phase 1, common areas and curb appeal. Why start there? Because you need to shift the market's perception immediately. By month 4, phase 2, attention moves to updating the unit interiors, which has the highest direct impact on rent growth. And then by month 10, phase 3, upgrading those operational and back-of-house systems for long-term efficiency. It's a very calculated, step-by-step rollout. But a nice timeline isn't enough. The math has to be absolutely bulletproof. The golden rule here, budget conservatively. Always assume renovations are going to cost 10 to 15% more and take at least 20% longer to complete. Actually, sometimes it takes even longer, so you absolutely need these built-in buffers to protect your capital. If a deal still looks incredibly attractive and works financially while assuming these heavier costs and longer timelines, that means you've got a true, realistic safety margin. Section 4, the execution differentiator, putting people over spreadsheets. Listen, a perfectly structured business plan with a conservative budget is completely worthless if you don't have a hyper-competent team actually driving the bus. Firms like Deko Capital rigorously evaluate their property management partners. Do they have real local market experience? Have they handled this exact scope of work in this specific neighborhood before? And on top of that, a totally transparent reporting infrastructure is non-negotiable. Investors need honest, real-time updates, not just glossy marketing.
Which brings us to a fantastic point from Deko Capital's founder, F.A. Ejifadomi. He says, the numbers on a spreadsheet don't execute themselves. People do. And wow, does that hit the nail on the head? You can make a spreadsheet project whatever returns you want, but the ultimate differentiator in any real estate asset is the human element driving those day-to-day operations. The community managers, the maintenance staff, the leasing agents, they're the ones literally creating the value. Section 5. Measuring durable value. Tracking actual performance.
Quarter after quarter, you've got to measure your progress against that original business plan, relying purely on hard data rather than hype. Think about the typical occupancy lift. By tracking tangible metrics, you can visibly see stabilization happening. You watch that leasing momentum build as occupancy climbs securely from an initial 88% up to a stabilized 94%. This proves the operational gap is actively being closed.
And we aren't just tracking occupancy either. There's a whole suite of key metrics that need constant monitoring. Rent growth ensures you're staying aligned with the market. Resident satisfaction scores are huge because happy residents mean high retention and low turnover, which dramatically stabilizes your cash flow. And monitoring your CapEx pace ensures renovations stay right on budget and follow that phased deployment we discussed earlier. The goal is to ensure the property is performing better simply because it's managed better.
So if you take only one thing away from this explainer, let it be this. Durable value is created by internal operational excellence. It is never, ever created just by crossing your fingers and relying on external market momentum. Real wealth in multifamily real estate is built on execution, not speculation. It comes from making a building a better place to live and a much more efficient business to run. Since value add is a hardcore operating discipline and definitely not just some catchy marketing slogan, I'd love to turn it over to you. Which specific part of this methodology should we dive into for our next explainer? Do you want to go deeper into finding that operational gap, or maybe dig into budgeting capital expenditures? Let us know. Thanks so much for hanging out with me to uncover the realities of value add investing, and as always, keep focusing on the fundamentals.